Johnson & Johnson shares trading higher on better than expected results this morning, also upbeat guidance. Joining us right now to talk about it is J&J's Chief Financial Officer, Joe Wolk, who's also a member of the CNBC CFO Council. And Joe, welcome. Thank you for being here today. Let's talk about the performance of the two divisions that you have. The first would be pharma, the second would be med tech. And it looks like pharmaceuticals in particular performed very well, a little better than expected, with operational growth up 6.4%.
That's correct, Becky. Good morning. It's great to be with you. We were really pleased with the overall company performance in the third quarter. I want to thank all of our associates across the globe that made that happen. It was driven by pharmaceuticals that enabled us to handily beat expectations on the top, bottom line, and then generate free cash flow that was very strong at $14 billion year to date. The pharmaceutical unit had 11 of 13 key products growing at double digits or more, another record revenue quarter for them at $14.5 billion, addressing serious issues across the market with our in-market products. But while the quarter was good, we're really pleased with what we solidified for the future, getting approvals, 5 approvals in all, addressing serious diseases like multiple myeloma, bladder cancer, lung cancer, and inflammatory disease such as ulcerative colitis. So we really solidified the future there. MedTech also solidified their future. We advanced our digital robotic general surgery platform for regulatory approval. And we also look forward to our pulse field ablation catheter for treating arrhythmia in the coming, let's say, weeks or months. That unit performed about 6.5% growth as well. That includes the acquisition of Shockwave, a business that we added back in late May to address calcification of vascular disease. And that without that, it would have been closer to 4%. That's a little bit below our expectations. We had some headwinds in the Asia-Pacific region, specifically with slower economies in China and Japan, as well as a prolonged physician strike in Korea. But overall, we're very pleased. While it's not perfect, it really speaks to the strength of Johnson & Johnson that we're able to miss on one part of the business, but still raise expectations for financial performance for the balance of this year.
Yeah, for your adjusted earnings per share, you're now looking at $9.91 for the full year. That's actually down from $10.05 previously. There's a charge of 24 cents that the street didn't know about before for the V-Wave acquisition, but there is a 10-cent bump in improved performance, operational numbers that you're anticipating. And again, that's coming mostly from the pharmaceutical side of things?
It's a combination of things. So we are managing our portfolio extremely well. We're also improving operating margins. We had high leverage on our SG&A costs through the year, really a testament to the organization and not allowing stranded costs from the Kenvue separation to creep into our P&L. And we're, I think, really living into deploying that next available dollar towards R&D, even without that charge of $1.2 billion that is classified on the R&D line. We increased as a percent of revenue our overall R&D investment. So while the quarterly performance is good, we manage for 3, 5, and 10 years, and we're putting our money where our mouth is in that regard.
Johnson & Johnson, or Barron's comes out with a headline on this that says Johnson & Johnson reports strong earnings, but the talc worries remain. It points out that the stock's up 3% for the year to date, but it's down 1.7% over the last 2 years versus the S&P being up 63.5% over that same time period. So what's the update on what's happening with the talc situation?
Yeah, so, Becky, we continue to make progress with the Talc litigation matter. I will emphasize to your viewers that irrespective, and don't get me wrong, we want this responsibly behind us, but we still generate enough free cash flow to continue to do the things that will strategically position us. It was decided that the bankruptcy court will be hearing the case in Houston over the coming weeks and months. This time is a little bit different than prior filings with respect to we have 83% of the claimants believe this is the right path to go. So if you think about bankruptcy law, its intent in this particular instance is to maximize potential for recovery while preserving otherwise viable businesses. We think it fits right into that. There are a few holdouts that haven't come along, obviously, when you only get 83%. But those holdouts, unfortunately, will personally gain either their firms or them individually financially. And we're real pleased that Senators Cornyn, Comer, Tillis, as well as Representative Ice are looking into some of the plaintiffs' bar tactics, specifically around third-party litigation funding.
Joe, the last time you were on, we talked to you about what you've done with some of the additional proceeds you've seen since the 2017 tax changes that cut corporate taxes. You've made the point that you've reinvested that money. We do have an election coming up in just a few weeks, and there are questions about what will happen to corporate taxes. What happens if corporate taxes go up to 28%, as Kamala Harris has recommended, versus staying where they are right now?
Yeah, so I think 21% is, quite frankly, the definition of fair share. It's square in the middle of economically developed countries and where their tax rates are. In fact, you may argue that with state taxes, the U.S. rate is actually a little bit higher. We have, as I mentioned in the last quarter call, added about 6,000 jobs. We were pleased to announce on October 1st the building of a new drug supply facility in North Carolina. Not only will that add 400 jobs to Johnson & Johnson's employee base, but there's estimates by the state of North Carolina that every job Johnson & Johnson adds results in about 4 to 5 jobs additional in terms of construction, electricity, plumbing, security that will happen in North Carolina. So we think this is very positive. I also look at what the CBO recently reported. So back in 2017, before the passage of the Tax Reform Act, the estimate for 2024 corporate tax revenue was about $405 billion. What came in 2024 is actually $529 billion. So it made the pie bigger. From my perspective, if you want a strong economy, keeping investment here in the U.S. and adding to it, 21% seems to be the fair rate. We are looking at another facility that is actually a little bit more advanced in terms of technology with respect to cell and gene therapy. If a rate goes to 28%, I think it's going to be very difficult to put that facility here in the U.S.